Hello, you're watching Dukascopy TV. I'm Ben Jones. The recent slide in emerging markets has caused many to speculate as to whether their economies are sustainable if developed economies continue to see growth. Joining me on the line to discuss this is Timothy Ash from Standard Bank. Now, Timothy, last week we saw huge changes to emerging markets. Turkey, India and South Africa are three of the biggest emerging economies that decided to raise their rates. Would you agree that there's somewhat of a seesaw effect where one side only seems to grow when the other is suffering? And in your opinion, can a balance be found?
Well, I guess ideally, one wants a global economy where emerging and developed markets thrive. I guess that one of the problems at the moment is that when we had the Lehman crisis, developed market economies had to pump extra liquidity into their own economies and into the global economy, and this created huge flows of capital into other markets, including emerging markets, and I think that created a huge distortionary effect. And unfortunately, we're now living with the aftermath of that as that money moves the other way as QE is taken off, and that's proving incredibly challenging for emerging markets. So it's very destabilising for many of these countries, and they are really, really struggling.
Emerging markets thrived after the financial crisis, but with increasingly less foreign investment, they're struggling. To what extent did developed economies work in tandem with emerging markets before the financial crisis, and how much do emerging economies contribute?
Well, pre-Lehman, I think emerging markets benefited through globalization, opening of global markets to all economies, and certainly they helped in that process. We saw huge development of places like China, India, the BRICS, etc. And then through the global financial crisis, you saw the use of the G20 organization, a lot of policy coordination, and coordinated loosening of policy. I guess the difference is the developed markets went even further, really, really aggressive QE, flooded liquidity into their own markets, and unfortunately, as I mentioned before, a lot of that liquidity ended up in emerging markets and distorted those markets. And it became very, very difficult for many emerging market policymakers to manage that liquidity domestically in their own economies, and now it's a huge challenge for them. As developed markets move to tighten, how you manage the outflows.
Some are suggesting that this so-called panic is actually unnecessary, and that emerging markets will see some benefits. As inflation spikes in the developed world, emerging economies will see a weaker currency and their exports will obviously be far cheaper than that of the US or Europe. Do you agree that there could be some pros to the situation, and could it be argued that things will not be as bad as many fear?
Well, weaker currencies will help growth in many emerging markets. Only the change or the move from very strong currencies to much weaker currencies can be very disruptive to markets and economies. So we're going through that disruptive phase at the moment. The other issue I'd kind of point out is I think many emerging markets sat on their laurels during that period of a flood of liquidity into emerging markets, and they could fund themselves very cheaply. And I think a lot of emerging markets didn't do the kind of reforms that they should have done to boost competitiveness. There's been a lot of focus on developed markets and their problems, euro periphery, problems in fiscal space, in labour markets, all those kind of things. But actually, a lot of developed markets began to look at reform, whereas I think a lot of emerging markets haven't done very much in reform in the last 3 to 4 years. And that's a huge challenge going forward.
Timothy, thank you very much for talking to us today. That is all we've got time for, but click back throughout the week as we'll be covering all of the biggest economic news stories. Goodbye.